I feel the UK actually is probably going to be one of the best opportunities, the largest opportunities in Europe. It hasn't launched in the UK yet. We will do it under co-branding of Mylky and Pulsin. We will do it with subscription-based apothecary type products, as we said, with ingredients, etc. We're very excited about launching it. It's done very well in different territories in Europe.
Hello, you're watching Proactive. I'm joined by Scott Livingston, the CEO of Tooru. Scott, very good to speak with you. Mylky went from launch to 9 million euros in revenue in just 2 years. What is it about this product that's caught fire so quickly with consumers?
Thank you, Stephen. Thanks for having me on again. So Mylky, in a very short space of time, has achieved incredible results, grown exponentially, and it is down to a number of factors. One, that the machine is quite unique in the way that it actually operates. They do have some IP in there in the way that they do it that actually makes for a better product. They're also extremely good at marketing, and they've done a very, very good job with D2C into channels in Europe. And we haven't launched in the UK yet, but we will be launching. But to do what they've done in such a short space of time is absolutely incredible.
You're paying £12 million for a business that's barely 2 years old, Scott. How did you arrive at that valuation, and what gives you confidence it's the right price?
Well, they have cash in the bank. They're very profitable. They have no borrowings. It's sustainable. One of our key drivers is that we have repeatable subscription-based ingredients and products that are being sold to that customer base alongside, and perhaps, for example, financed machines where people pay a subscription. They get the equipment, they get a weekly or monthly sachet, perhaps cross-branding with Pulsin, for example, and some of Pulsin's ingredients that we might use in various milks, and also as an apothecary to potentially make your own sort of protein balls or protein bars at home. And I think this is a fast growing opportunity, and obviously got 70,000 customers there, over 70,000 users that are free from buyers. They have that lifestyle. This is a key marketing aspect. The power of that database is very valuable. And at the end of the day, in terms of risk, we're paying 2 times EBITDA on cash. 1 times EBITDA on equity. We're doing a 17 million valuation of Tooru, which is about 0.77 a share, I think, when you add in the post-money valuation to 20 million, and then vendor finance of the 3. So we've put it together in a way that is attractive to them, but also is reasonably low risk for us. And when we borrow 6 million for the cash up front, when you talk to the lenders at 2 times EBITDA, this is a safe, high street, should be reasonably low cost type borrowing situation.
What does it say about your own valuation, Scott?
Well, we believe, biased, that we're undervalued dramatically. We negotiated a 70 million valuation because we were talking about, there are a lot of incredible examples of multiples of sales in this industry. We have a very modest multiple of sales of 1 point something related to their multiple of sales. We have a very profitable Juvela, Oath's growing, Pulsin's growing. So, we wanted to come to the table with a similar sort of valuation. They recognize that. And they accept it. So that, and interestingly, the combined group should be circa 25 revs, 5 EBITDA for the operating subsidiaries. It's a serious scale business, and they recognize that their shareholding will be significant, as will ours. And we would obviously hope for a re-rate in our valuation eventually, although we're trying not to be too focused on the share price because it would drive us crazy. But obviously the key here is that we don't want to raise capital at such a low valuation. We're going to use debt because we have the cash flows to support it, to avoid dilution for stakeholders.
Mylky is already in 8 European countries. As you mentioned, Scott, it's not in the UK yet. How big is that opportunity, and how quickly can you move on it?
So we feel the UK actually is probably going to be one of the best opportunities, the largest opportunities in Europe. It hasn't launched in the UK yet. We will do it under co-branding of Mylky and Pulsin. We will do it with subscription-based apothecary type products, as we said, with ingredients, etc. We're very excited about launching it. It's done very well in different territories in Europe. And we can see exactly why. One thing we like about their business, they're very process-driven, very data-driven. We have access to all sorts of trends that are going to help us cross-promote between brands and obviously launch this product and types of products in the UK and other markets where they haven't launched yet.
So you already mentioned the Pulsin synergies, Scott. How does it fit with your other brands like Juvela and Oaf? What sort of synergies are you seeing there?
Yeah, so Oaf again, Oaf is that free from the same sort of story. We have a lot of opportunity here, a lot of strength in the category. And the key here is that everything is wellness, everything is free from, but everything has particular different type of market and consumers to a point, and there are little, nuances to each one. But we have a strategy decision to make, which is what brand would we launch it under? How can we cross promote the other brands alongside? But the key here is that we got a mass consumer demographic database that we build that obviously is going to be happy to buy all the different brands from us.
You described this as the first step in a buy and build strategy. What does the pipeline look like? What kind of brands are you looking for next?
So these deals obviously do take time. Certainly these larger ones, or large for us. We are looking at lots of other smaller little ones that would be quicker and easier to implement and close, lower risk, where maybe we would be long-term upside equity. We're helping to stress small brands. We have a lot of them on our table. To be doing material deals like this is obviously it's complex. It was going to require DD process. It's going to require advisors and costs. So, we want to be doing perhaps one of these a year. If we do, it'd be wonderful if we could do two, but we need to be careful. We need to maintain risk. We need to try and build a stable, process-driven business. And obviously, as we grow, we'll be attracting more skill sets into the group in investor relations and in M&A and in integrating these businesses into a larger, wider organism, essentially.
Well, Scott, congratulations on this latest deal. I hope you'll keep us updated on your progress with it.
Thanks, Stephen. Thanks for having me.
Very welcome, Scott Livingston, the CEO of Tooru.